What do you get when you combine SD bullion and the New Zealand Mint? You get the lowest price silver coin ever released to the world. Introducing the Roaring Lion, a 1 ounce, 4 nines fine silver coin with micro engraving security that retails for lower than some of our competitors sell silver bullion rounds for. Check out this magnificent beast, the Roaring Lion silver coin, at sdbullion.com/roaring. That's sdbullion.com/roaring. All right, all right, all right.
Hey everyone, this is Elijah Johnson with silverdoctors.com for your SD Weekly Metals and Markets Wrap. And with us today is our co-host Eric Dubin, and our guest is Rick Rule from Sprott Asset Management. Rick, thank you so much for joining us today.
Always a pleasure, Elijah. Thank you for having me on.
All right, now I'd like to pass it off to Eric right now, actually, because he has one of the big stories this week, and he was going to ask you about that, Rick.
Yeah, Rick, we've gone through typical January upswing after the selling that comes into the end of each year, and we're going through the process of the Federal Reserve threatening to restore their balance sheet, normalize it, raise interest rates. And this week we got a story out of Bloomberg commenting about what Chinese market officials might be doing with respect to their foreign exchange management policies and holding of U.S. treasuries and whatnot, and kind of spooked the markets and gave a bit to the precious metals. I was kind of curious what you think about, the underlying conditions in the bond market. I mean, we finally, in the 10-year yield, got over some pretty significant upside resistance as people are getting really nervous about the conditions in the credit markets. And I'd love your take as to how you see that and maybe inflation trends and how that colors what we might be looking at when it comes to the Federal Reserve's threats and how that impacts precious metals.
You've covered a lot of ground, and that truly is a $64 trillion question. At the beginning, I'd like to say that might be above my pay grade, but let me deal with the topics that you've asked in as sequential a form as I can. In the first instance, with the 10-year Treasury, we have talked on this show before about the fact that my own belief is that the Treasury hasn't represented good value. It is, in fact, the deepest and most liquid security in the world, and it is the default security and the security against which everything else is measured. Some years ago, when I mentioned to an Asian parastatal client that is a client of Sprott, my concern about their holdings of U.S. Treasuries and about the fact that the yield relative to the depreciation of the purchasing power of the U.S. dollar, and I don't mean the CPI rate of inflation, I mean the actual degradation of the purchasing power of the dollar. Mm-hmm. And I said that as an investment, the 10-year Treasury, in my view, represented a bit of a lie. I'll never forget my Asian counterparty looking at me and smiling and said, "Yes, Mr. Rule, in effect, we agree, but yours is the deepest and most liquid lie on the planet." And while we don't necessarily trust you, we trust more than we trust each other around the rest of the world. So people who are forecasting the demise of the U.S. dollar or the U.S. 10-year Treasury need to remember Doug Casey's quote, which is that the U.S. dollar is the prettiest mare at the slaughterhouse. That is, while it is perhaps overvalued, it has attributes in terms of liquidity and being backed by a culture that has generated wealth for a long time that give it a franchise that will require, I think, substantially more depreciation before it's in any danger of collapse. That being said, I wouldn't own it. When you look at the yield on the U.S. Treasury, 10-year Treasury, now 2.5, from my viewpoint, although the CPI stated rate of inflation is 1.6, the CPI stated rate of inflation, when it's inconvenient, doesn't discuss food or fuel, which is problematic because I both eat and drive. You will notice also that the CPI doesn't include tax. If I didn't have to pay tax, I wouldn't complain quite so strenuously about the index. But the truth is that the CPI stated rate of inflation has nothing to do with the deterioration of the purchasing power of my own principal held in US dollars. I believe that lending money to the US dollar to the US government, when they promised to pay me a 2.5% rate of return, and the purchasing power of my dollar depreciates at the places I shop, and I'm a cheapskate, at 4% a year, that suggests that the government is proposing to charge me 1.5% a year for the privilege of holding my money. Franz Pick described that as a certificate of guaranteed confiscation. Jim Grant described it as return-free risk. Irrespective of the quote that you choose to use to borrow credibility, those are unattractive outcomes to me personally. Now, is the bond market in difficulty? In the near term, perhaps yes. If we were to see a liquidity squeeze in the market in the next 6 to 12 months, and I'm not saying we will, by the way, this is not a forecast, this is a discussion. Were we to see a liquidity squeeze in the market in the next 6 to 12 months, remember that the most liquid instrument in the world is the US 10-year Treasury. And the response that the market would have to that would be a flight to perceived safety, which is in every circumstance the US 10-year Treasury. So while it isn't appealing to me, it is appealing to investors around the world, particularly investors who are not predisposed to gold and silver, which is to say practically everybody. Looking forward, however, it's interesting that gold bugs or silver bugs talk about gold and silver winning the war against bonds. Ain't going to happen. Didn't happen in the 70s. Importantly, for the bullish case in gold and silver, it doesn't have to happen either. There was a study published last year which suggested that bullion and bullion-related equities and investments, that is, precious metals related investments in the United States, occupy between 1/3 and 1/2 of 1% of the total investable assets in the United States. In 1981, the comparable number was 8%. And over 3 decades, the median was about 1.5%. Precious metals don't need to win the war. They need to win it less badly. If you had a reversion to a 3-decade mean, demand for precious metals and precious metals investments in the United States, the largest investment market in the world, would quadruple. That would be fine for me. So, a discussion about the bond market. 2 parts of the discussion. I wouldn't buy it, but other people might. Next, will we will we as precious metals investors win the war against bonds? No, but it's irrelevant. We don't need to win the war against bonds. All we need to do is lose it less badly. Now, irrespective of in the near term, does the US 10-year Treasury market break down? You need to, as an investor, not as a speculator, as an investor, look at the bond in the longer context. The US 10-year Treasury has been in a bull market since 1982. That means it's been in a 36-year bull market. So if that market isn't over, if that bull market isn't over, it is certainly closer to the end than to the beginning. The bull market has caused the yield on the bond to fall from 15.6 to a low of 1.6 before recovering to 2.5. Suffice it to say, if they take the bond any closer to 0, the bond loses adherence. If the interest rate goes up, by definition, the bond goes down. So we are closer to the end of that bull market, the 10-year Treasury bull market, than we are to the beginning. And if you agree with me, and history shows this to be the case, that gold, more than anything else, trades inversely to the US 10-year Treasury and the US dollar, that would suggest that the precious metals bull markets, conversely, are closer to the beginning than to the end. I know from your point of view as web portal publishers that you would like from me a specific prediction as to time and price, but I'm much too old and much too wily for you to get anything other than narrative out of me.
we wouldn't put the match to your feed. Don't worry, Rick. It's interesting though that the bond market has been expressing fears of deflationary crashes over the last, number of years as we've rebooted from the 2008 crash. So that has brought interest rates down when market participants were looking to ride that, as well as, participate in capital appreciation. But we're seeing inflation pressures begin to percolate through the markets now, and that is tied as well to this so-called fake news report that China denied when it came to Bloomberg's story about China, managing their forex reserves differently and treating their holdings of bonds differently on a going-forward basis. I wonder if you think that this year will, in fact, see an increase in inflation pressures in our economy, and how that can, in fact, be explaining what we're seeing in the bond market in part today now, and that being a positive for precious metals. I mean, most people, when they look at this whole threat from the Federal Reserve and their ongoing propaganda, managing market expectations about their, resetting of their balance sheet, they expected rising interest rates on the short front from the Federal Reserve is going to hurt precious metals, and that's not always been the case historically. I don't know why people don't pay attention to market history, but that's just where we are. So I'd love to know what you think as far as inflation trends, our economy, and how that's even in the oil market too. You have a lot of understanding of what's going on in the petroleum world, and it's been fascinating to see how there's been a significant turnaround in oil.
Your second to last point was really interesting to me. There is this supposition in the market that as interest rates rise, the gold price can't go up. I came into my investing career in the 1970s when the interest rate went up fourfold and the gold price went from $35 to $850 an ounce. The question is, why does the interest rate go up? If the interest rate goes up because people need more compensation because of the depreciation of the purchasing power of the dollar, in other words, if it's demand pull inflation, clearly the thing that made the interest rate go up makes gold go up. People need to understand that. It's a very, very important determinant. Again, you covered many subjects in your question. I'm just back from China. I was in China last week, and I'm by no means a China expert, but we have some very large clients in China who I talk to a lot. And I don't think that you'll see the Chinese dumping the U.S. treasuries. I don't think you'll see them do it for two reasons. One, the holdings of foreign reserves that the Chinese have are so large, and the U.S. Treasury is such a large and liquid class that I don't think that you'll see them dump U.S. treasuries for portfolio reasons. I think you'll see them run down the treasuries over time as they invest the capital that they had invested in treasuries into capital projects like the Belt and Road. But I also would caution your listeners to understand that part of Chinese economic development strategy is to maintain a very strong export economy while they develop their internal domestic consumer market. And that requires that their currency be competitive against the US dollar. It is not in the interest of the Chinese state to foster unemployment in China as a consequence of a strong currency relative to the US currency. The disintermediation that you will see in U.S. Treasury holdings among the Chinese won't be strategic or political. It will be in a response to them having better opportunities for the deployment of capital, and it will take place over 5 years. Moving on to your discussion about the oil and gas business, you may recall that the last time that I was on your show, it was pretty easy for me to say that the oil price was going to go higher. That's because the oil price was unsustainably low. The International Energy Agency said that the global cost of producing a barrel of oil, including the cost of capital, which many of the producers leave out, was $60 a barrel. So at that point in time, we were making the stuff for $60. We were selling it for $45, losing $15 a barrel 100 million times a day. Eventually, that got boring. And people, meaning oil companies, particularly state-sponsored companies, began to invest less money in their oil business. They deferred sustaining capital investments. The International Energy Agency estimates that postponed capital expenditures and deferred sustaining capital investments worldwide since 2010 have been in excess of $2 trillion. And this has led to what I think may be terminal declines in places like Mexico with the Campeche field or Venezuela with the Maracaibo field. The oil price hasn't gone up because of any rebound in global oil demand or a synchronous rebound in global economies. It's gone down because we've destroyed productive capacity on a global basis. Now, where it goes from $65 a barrel is a much more interesting question than where it was going to go from a $45. At $45, you had one of two outcomes. Either the oil price could go up above 60, or you wouldn't have any more gasoline. And you had to decide which was a more probable outcome. To me, obviously, the price going up was a more probable outcome than my car sitting rusting in the garage. That's something that was going to happen. Moving on into, at least as far as I remember it, the final part of your question, which had to do with inflation versus deflation, like the old Chinese curse says, we live in extremely interesting times. We have a circumstance in the market right now where there's lots of liquidity. There's cash everywhere. The concern is solvency, which is different than liquidity. In the United States, as an example, there's mixed signals. Corporate balance sheets are in spectacular shape. In 2006, companies were hiding debts in offshore subsidiaries so that you couldn't get a feeling for their total obligations unless you looked at them worldwide. Now companies are hiding cash in their offshore balance sheets. So the S&P 500 has pristine balance sheets. The 2008 collapse had a profound impact on corporate treasurers. The circumstance is different, however, in Washington, where our on-balance sheet liabilities are $20 trillion and our off-balance sheet liabilities include, at least according to the government, who had no reason to understate them, exceed $100 trillion. So we have $120 trillion in liabilities at the federal level. This is before underfunded pensions, before state debts, and before local debts. So our solvency is in question, which is clearly deflationary. But as a consequence of printing, that's official speak for counterfeiting, we have lots and lots and lots of liquidity. I liken it to somebody out here in California who has a $2 million mortgage, which is probably beyond their ability to service with their income, but they have $10,000 in their jeans. The fact that they're insolvent doesn't mean that they can't go out and buy some whiskey. They're liquid. They're just not solvent. So I think from a solvency point of view, you have a deflationary circumstance. That deflationary circumstance, however, and that fear of deflation means that there are inflationary pressures, because the way that the powers that be, in fact, the way that the voters would prefer to deal with it, is to default on our obligations on the installment plan. That is, rather than deal with the off-balance sheet liabilities by telling old folks like me that you are not going to give them Social Security, and you're not going to give it to them in the amount that you promised them. You will give them Social Security, but you'll inflate away the net present value of your obligation to them by printing. So we're in an interesting circumstance. We have inflationary pressures and we have deflationary pressures. We would seem to have an economy that has stopped shrinking. The evidence of economic growth that I see on a global basis is probably much more muted than what other people see, and probably is more related to liquidity and artificially low interest rates than it is to demand. But I notice anecdotally that when I talk to some of my clients, they are beginning in their own businesses to make capital investments and hire people. This wasn't the case 2 years ago, where although there was capital availability, nobody was borrowing and nobody was investing because there was no unmet demand to meet. Anecdotally now, I'm starting to see clients and I'm starting to see people that are coming to Sprott for money that are beginning to make capital investments because they're beginning to see some unmet demand. And that's very inflationary if it occurs. If we were to see an economic recovery to increase demand, as an example, for various types of mineral commodities, after 5 years of supply destruction, an increase in demand without the ability to increase the supply, and make no mistake, in the near term, we have no ability to increase supplies, that would be very inflationary and also bullish for the whole commodity sector. That's not a prediction on my part, by the way. It's just a discussion of where I see the market.
Mm-hmm. Definitely. Now, I'd like to move our focus to the precious metal markets before we have to let you go. Ever since, mid-December, it seems like precious metals have been doing very well. Gold just this week is up $20. What is your perspective on why precious metals have been rising recently? And also, what about the miners? Because I know they've also been doing well. The GDX is up this week as well.
Let's do the metals first. The first thing is that there's a tremendous amount of liquidity in the market. And every asset class has done well. Gold is playing catch up. There is a fear, I think, among some people that not the liquidity crisis, but the solvency crisis comes home to roost. I think people with money, which is a small part of U.S. society, took a look at the political demand of the Trump tax passage and said, I get it. The fix is in. Everybody wants a pay raise. In other words, everyone wants a tax cut, but nobody's willing to cut expenditures. So what we have done is we've all voted ourselves a pay raise, and we're passing the bill for the pay raise on to the unborn or those who can't vote yet. Elijah, thank you. Once again, your generation subsidizes mine. And I think the idea that we're proposing to, in effect, raid our IRA to go drinking tonight makes people nervous about the commitment that the United States society has to its own economy. I think in the near term, more than anything else, an observation of the way U.S. society reacted to its fiscal problems, which is to say, enjoy today, don't plan for tomorrow, caused people to remember the efficaciousness of gold and the fact that gold is one of the few mediums of exchange that's simultaneously a store of value. It isn't a promise to pay like the US dollar. It's payment in and of itself. So I think that was important. With regards to the gold equities, I think you have a different circumstance. And right now, in the near term, an almost unrelated circumstance. Gold did well as an asset class in 2017. It didn't just hold its value, it increased in value despite confidence in every other asset class, including the US dollar. So gold performed better than most gold bugs think it did, while the gold equities performed very poorly, meaning that there was a performance gap between the gold equities and the gold price. A performance gap that I think was reflected in two prior conditions. One was the extraordinary performance of the gold stocks in 2016, from which a retreat was a natural and normal reaction. You'll recall that the better juniors were up uniformly 100% in 2015. And to expect them to continue that performance without taking a rest, I think, was an unrealistic expectation. But I think there's a more important factor present. And that's nuanced. For 40 years, since the 70s, what investors have expected from gold stocks is for them to be leveraged warrants on gold. And so what investors have asked gold companies to be is they've asked them to exhibit leverage to gold. Now, ironically, that's an interesting thing to ask. The companies that have the most leverage are the most marginal. If you're a high-cost producer and the price of the commodity goes up, your margin increases faster than an efficient producer. So for 40 years, investors have asked the gold mining industry to become leveraged or marginal. And the gold mining industry has done exactly what we asked them to do. It became an extremely inefficient industry, which is funny. That's evidenced, tragic but funny. It's evidenced by the last bull market in gold, the 2000 to 2011 market, where the commodity increased in price from $260 an ounce to $1,900 an ounce. Pretty impressive bull market, a six-fold increase. And free cash flow per share among gold producers declined. Now, that took special skill. If you take a commodity price that increases sixfold and you reduce your cash flow per share, that's almost laughably inefficient. And so the expectation that even gold investors had in the gold shares has been horrifically bad. While that's happened, something interesting has happened among the gold producers, though. The management teams that presided over that dismal performance over the 16-year bull market were invariably thanked and excused, allowed to pursue other employment opportunities at 7-Eleven or someplace that deserved them. And the management teams that replaced them and the investors who came to own them began to ask those businesses to become efficient allocators of capital. When you sit on a quarterly conference call for a gold mining company now, the discussions that you hear are capital allocation efficiencies, operational efficiencies, free cash yield, discussions that you never heard in 2002 when they were all talking about growth. And the consequence of that is that the financial performance of gold mining companies in 2017 was good, even while their share price performance was bad. In 2018, I believe the market's going to notice this. The expectation that the financial industry has for the gold mining industry is so low, so abysmally low, that the gold mining industry has almost no difficulty in exceeding expectations because the expectations are effectively insolvency. At the same time that the expectations are low, the focus on the industry has begun to be financial results. So I think that the financial results will exceed expectations substantially. And sector performance in the equities market is driven by, more than anything else, by exceeding expectations in the near term. And we are beginning now to see a change from negative expectations associated with gold stocks to neutral expectations for gold stocks. There's still no expectation for outperformance. There's just the realization that the industry is exhibiting free cash yields, which is never done before. If I'm right, if the industry, the producing part of the industry, exceeds expectations to the upside, and if the share price goes up, the second positive shoe will fall. That is that the industry has underinvested and misinvested for 16 years. It's becoming capacity constrained. Remember that every day that you mine gold from a gold mine, your business gets smaller. It's in liquidation. And if you produce this without putting in place the investments necessary to replace it, eventually you mine yourself into extinction. We've seen precipitous production declines among the largest gold miners in the world. And there is a realization on their part that if they begin to explore now, they can address this production decline in 12 to 15 years. But they might not be around in 12 to 15 years, which means as their free cash flow from operations increase, and as their share price and hence their cost of capital decreases, share price increases, cost of capital decreases, I think that you're going to see a renewed renewed emphasis on merger and acquisition. Not the stupid kind that occurred in 2002, where you bought a company that had a large low-grade deposit, the grade equivalent to dishwater, but rather acquisitions that are accretive, that are strategic, perhaps a third deposit in a region where you already have two deposits. And I think this combination of a relatively strong gold price and much stronger than expected financial performance and mergers and acquisitions holds out the possibility of a 2018 and 2019 that surprises most observers, myself included.
All right. Well, Rick Rule, thank you so much for joining us today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, of course, my perpetual thought, which is that if you like what I have to say, I'd love it if you listen to me more. The easiest way to do that is come to our website, www.sprottglobal.com. Subscribe to our blog, Sprott's Thoughts. I guarantee you'll get your money's worth because it's absolutely free. Finally, I would encourage any of your listeners who want to learn more to consider coming to what I think is the world's finest natural resource investment conference, which is the Sprott Vancouver Natural Resources Investment Symposium in Vancouver, British Columbia. Join myself, Jim Rickards, David Stockman, Doug Casey, Jim Grant, Franco-Nevada Mining, Silver Wheaton, the World Gold Council, the Silver Institute, the Platinum Investment Guild. It's, if you will, Woodstock for precious metals investors.
All right. Once again, Rick Rule from Sprott U.S. Holdings, thank you so much for joining us today.
Thank you, gentlemen.